Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. And I last spoke to you a couple of weeks ago, and at that time I talked about the third quarter. And I said, it's been a tough quarter, very volatile, and it was down. We've taken some steps back as it relates to the unmanaged stock market indexes. So far this quarter, in the last couple of weeks, that has continued on the downside. Nobody ever minds volatility on the upside. Okay. One thing that's interesting is over the last 25 years, the daily average of volatility has been 0.77%, about 0.8% on a daily basis. So far this year, for the first half of this year, it was 0.5%. It was kind of the average volatility on a daily basis. Well, one of the reasons why the last 2-3 weeks has seemed so alarming is because the volatility has been over 1%. And so it's 2 to 3 times what we've been kind of lulled into feeling the first half of this year, and also what is normal when we look back over a 25-year time frame. 2 weeks ago, I mentioned that the smart money looks at the data and what's happening now and says, okay, so how far of an outlier is this? Is this something that it actually happens quite often or periodically, and that it's a part of the game of investing, part of what we should expect? Or is this a precursor to something much more deadly? Are the fundamentals telling us that this is an early canary in the coal mine of some bad thing that's going to happen? And my answer is the first, not the latter, in that this is actually normal, even if it is painful, of part of the process. And when we look at a longer time horizon, which is what sort of the smart money should do, is looking at it from where does this fit in 1 year, 5 year, 10 year, and even longer than that. I'm going to throw up on the graph there, up on your screen there. Looking back over a 17-year time horizon for the S&P 500, which is an unmanaged stock market index, and this is as of September 30th. I'm going to put a little red mark where we are right now, just to give it some perspective. I'm doing this Tuesday night, so I know exactly what our closing number was, and hopefully you're getting this on Wednesday or Thursday. You can kind of see that in the whole scheme of things, we could have said at that other line that I just put in there, yeah, see, it's a top. It's not going to go any higher. And then we could have done it all the way from that bottom arrow all the way up to where we are today. We could have said, oh my gosh, this is the high. It can never go any higher. I'm going to put on the screen there a second graph, which is looking back 114 years. And you can see that there are consolidation periods and then there are times of advance. Consolidation periods and times of advance. You can see there, and I've just circled it, where I believe that we are. I actually believe that we are on a longer term advance than we are a consolidation or a decline. Other people can make an argument to the downside. That's okay. We always joke that economists have predicted 17 of the last 3 recessions, and so that's an easy thing to do. The hard thing is for me to try to be as straightforward with you and say, this is a part of that long-term process. As a matter of fact, our emotions have a tendency to want us to react in the wrong way. I'm going to throw a chart up on the screen there. You can see that in the late 90s, consumer confidence was an absolute high, but that was the worst time to buy. Okay. Now you're going to see back in the beginning of 09, which was the beginning of that huge upswing that I showed you in the first graph, that consumer confidence was at a low. And then 2 years ago, right before last year's really strong stock market gain, consumer confidence was once again at a low. So it's almost contrary of what you would think, like, oh, well, people are feeling all negative, so the market must go down negative. No, that's quite the opposite. It's a kind of what we call a lagging indicator, where people actually do the wrong thing at the wrong time. The next graph that I want to show you is up on that screen there. I think this is absolutely essential. What you're going to see is those red numbers at the bottom are the intra-year declines. What that means is if the market was up 10% and then it dropped 7% and it ended the year at 3%, or maybe it even ended at a different number, the high to the low throughout that year is normally a 7, 8, 9, 10, sometimes double digits. So it is normal for there to be corrections within the year, it does not mean the year will end that way. And so I think that's absolutely essential for us to keep in mind, because we do take 5 steps forward at times and 4 steps back. But if we believe that in the future the market will be higher than where it is today, that's why we have investments. If we didn't believe that, why would we have investments? Keep it in your mattress, keep it in the bank. That makes no sense if you believe that long term the market is going to be lower than it is today over a long term. And I think that that's not a very wise bet. Now I'm going to throw another chart up on the screen. It's a table. And the reason why I throw this up there is because there's a, well, you know, it's just like the 1990s or it's '07. Well, let me just tell you, look at that price to earnings ratio of about 15%. Well, it was double that back in the late 90s. I mean, from a valuation point of view, we're nowhere near where we were in previous times when we've had a huge decline. We have lots of cash, huge profitability, leveraging is down, and so this is a very good thing, and the fundamentals, I feel, are still strong. This last graph I want to show you, I think, is very, very important, and that it shows historical returns by holding period. And what you're going to see is that on a yearly basis, that's the one on the far left-hand side, there's a huge variance. The left one is 100% stock, unmanaged stock market index. The next one is 100% bond index, and then there's a mix of the two together. With a 1 year, there's a huge variance. That's just the way things work. But once we look out 5 years, 10 years, even 20 years, that variance, that kind of expected returns or that highs and lows have a tendency to kind of, the highs go lower and the lows go higher. And for a 50-50 split historically, of course, it could be different in the future. There's actually never been a 5-year time frame when you haven't, the worst you've done is made 1% a year. And so moving out to cash, thinking that you're going to try to outsmart everyone else, that you are reading the headlines and you've got some supposition about what's going to happen in the future, I think is not very wise. The very last thing I want to show before I cut this video is the benefits of having a stock and a bond mixed together. You've seen me do this before, even with my hands. Up on the screen there is the 10-year Treasury note yield, and it's declined, which is a good thing. The yield goes down when the price goes up, and so you can see that this is actually huge volatility in the last year. Those arrows there are in the last kind of year to date. And so this has been a great year to have bonds. And so in hindsight, having 100% of your portfolio in bonds would have been a fine thing to do. Now, we don't know hindsight, so that's why we have a mix of stocks and bonds. And of course, that mixture depends on the client what's appropriate. And of course, having a well-diversified portfolio does not guarantee against declines in a general declining market, but I do believe that it is the wise way to go going forward. You can see that in the last month or so, as the stock market has really gone down, that the bonds have actually gone up. And once again, we know that because the graph went down, which is counterintuitive, but it actually meant that bonds went up. So this is a good thing for bonds when the graph looks on the downside from left to right like that. That's what I have for right now today. I'm going to continue with these updates to you, my clients, and to my friends and prospects, prospective clients. I'm here if there's any concerns that you have. 303-747-6455. Investments are a part of the big picture of getting you to where you want to go with your goals, etc. But I'm not overly freaked out about where things are at this point. Hey, would I wish that things were higher? Of course. But do I overreact and scrap my plan based on some weeks and months of data? Absolutely not, and you shouldn't either. Mike Brady, Generosity Wealth Management, 303-747-6455. You have a great day. See you. Bye-bye.